Good day to you. Okay, so we're going to dive straight in. We're actually dealing with fidelity cover today, one of the most important areas of insurance in community scheme when it comes to risk. We're going to deal with homeowners association, share block, and bodies corporate insofar as the Community Scheme Ombud Services Act goes, and then more specifically, sectional title legislation. Okay, when it comes to fidelity, the CSOS Act speaks to all, but then the Sectional Title Schemes Management Act, Prescribed Management Rule 23.7 to be precise, will speak to sectional title. So you need to look at both the rule and regulation in CSOS as far as sectional title goes. Okay, so what does it say? So let's start off. CSOS, or Community Scheme Ombud Services Act, Regulation 15. And then we're going to go to Sub-Regulation 15.1, which says, for every community scheme must insure against the risk of loss of money belonging to the community scheme for which it is responsible, sustained as a result of any act of fraud or dishonesty committed by any insurable person. Okay, now that's actually says it all. Basically, fraud and dishonesty needs to be covered. Okay, now it speaks about an insurable person. So in other words, the scheme needs to be protected against an insurable person's dishonesty. And who would that insurable person be? And that will be a scheme executive, be an employee or agent of a community scheme who has control over the money of a community scheme. It will be a managing agent or a contractor or employee or another person acting on behalf of or under the direction of a managing agent who is in the normal course of the community scheme, or access to control over the monies of the community scheme. Okay, so the insurable person is an important factor, but very often this insurable person aspect is overlooked or misunderstood, I should rather say. Misunderstood because many people, managing agents included, do sometimes think that this body corporate's insurance is actually covering them. Okay, it's not covering them. It's protecting the body corporate against their dishonesty. If the body's corporate insurer is actually paying out a claim because, say, a managing agent staff member was dishonest and pays out a claim, it is highly likely that the body corporate's insurer is going to now come to the managing agent to recover their money. So the managing agent is probably more important now that the managing agent has their own fidelity cover to back them up. Okay, so then sub-regulation 3 is quite important. That is sets out the minimum amount by formula. The minimum amount of fidelity insurance cover required in terms of sub-regulation 1 is the total value of, and then they state A and B. So total A and B equals total. A is the community scheme's investments and reserves at the end of its last financial year. Okay, that's what it says. And B, 25% of the community scheme's operational budget for its current financial year. We set out an example. We've got a 15-minute explainer on fidelity in this YouTube channel. So you can go back and find it. The thumbnail looks like this, and you can sure go and have a look and watch that one. There's also another clip, by the way, another short video by Candace. Candace sets out insurance in the AGM, where we also gives a nice way of presenting this per an agenda item. Okay, then so that sub-regulation 3 deals with the minimum amount, and then I do go and explain that you need to read that in conjunction as a body corporate with prescribed rule 23.7. As an HOA or a share block, you look at your constitution or your MOI documentation to understand any other fidelity agreements or legislation, we'll call it rules or regulations you might need to comply with. Okay, then sub-regulation 4 simply provides that this insurance must be modernized in 2 ways compared to the old way of doing fidelity. In the old way of doing fidelity, you used to only be able to get paid out once the naughty person was convicted by a court of law. What they are saying here, which further protects the body corporate, in other words, they don't have to wait for their money so long. It must provide for payment of a loss by the insurer to the community scheme within a reasonable period after reasonably satisfactory proof of the loss has been furnished to the insurer. And B, not require that criminal or civil proceedings be taken or completed against the insured person before a payment is made. There is also sub-regulation 5, which I'm not going to discuss because I don't believe it is a good thing. I will say that it just pertains to an alternative. In other words, rather than do this insurance, that you can get an interest or your interest as a scheme noted in the managing agent's policy, for example. It is just not the route to go. In fact, any losses that occur seem to occur around this at the moment, or near misses, I should say, so far. But really, it's really not the way to go. We're actually recommending that sub-regulation 5 be removed from the statute book. We've actually told the authorities that this is a bad idea. So I don't think that should be there for very much longer if our advice is followed. But I'm not going to go into that, and I certainly do not recommend that you even consider regulation 5. Okay, so that's the CSOS Act regulations. If you go over to prescribed management rules for bodies corporate specifically, first of all, the agenda items on how to set it out, and as Candice explains in the video clip, is set out in prescribed management rule 17. That's your agenda rule. And then that in turn refers to prescribed rule 23.7, which says that a body corporate must take out insurance for an amount determined by the members in a general meeting, hence on being on the agenda, to cover the risk of funds belonging to the body corporate for which is responsible, sustained as a result of any act of fraud or dishonesty committed by a trustee, managing agent, employee, or other agent of the body corporate. Okay, so read CSOS Regulation 15 and Prescribed Rule 23.7 in conjunction. And in a nutshell, what it's saying is there's your minimum amount, there's a formula on how to work it out, and then go to your AGM with that cover and ask the owners whether they're satisfied, whether that's enough or whether they need more. Where would you need more cover? Well, you might need more cover, for example, if your body corporate was planning a special levy of some great substance, which would have changed the figures substantially, and you might need more cover. Or you were going to have a windfall, you were selling some sort of asset or a chunk of land, and you're going to have a few more million rand in your bank account. Maybe you would want more fidelity cover under those circumstances. Okay, that's it in a nutshell. Don't forget the 3 things, of course, like, subscribe and share. We'd love you to do those things. See you again, and see you on this channel more.